Hello and welcome to this week's short strategy session with me, David Jones, and Trading 212. Now, some of the comments in recent weeks have asked about what is price action trading, what's trading off the price. So I thought this is a good opportunity to do maybe a series of short videos on price action trading, starting off with this week. Put simply, it's trading off what the price does. In recent weeks, we've covered things like Fibonacci, moving averages, stochastics, all that sort of thing. And these things, well, for some people, have their place, but ultimately, what moves markets is the actions of buyers and sellers. It's not what your 10-day RSI is doing. So, where better to start when it comes to looking at, well, should I buy or should I sell, than what the price is actually doing. So I thought we'd start this off in a fairly simple way this week and maybe expand on the idea over the next couple of weeks about what is price action trading all about. So as usual, to start off with, let's have a look at one theoretical approach as to how it could work. As usual, let's take a look at our theoretical market. So we've got a market that's maybe sold off in the morning, has hit a level, the buyers have come back in, pushed it up, but as is often the case, we don't see markets do a handbrake turn and reverse straight away. The market might come back down, and this is where our setup could get interesting because we're looking at this previous low in this example. Let's say in this theoretical market, it traded down to 100 last time round. The buyers came back in, pushed it up, and we've come back down to retest it. So we're looking to see, is there confidence again ahead of this level? So what we're trading here, this is price action trading. We're not looking at things like moving averages and stochastics and Fibonacci. We're looking at what is the price actually doing. And the benefits of trading off this, there are a couple. It gives us, first of all, a definite area where we want to get in. So if the market here is trading at, let's say 105, our argument for the trade is we've held above what was a level, an important level before, whether that was earlier in the day, yesterday, or the previous week, a level where market sentiment changed. So if we're a buyer at 105, we've got a relatively logical place to put our stop loss because the whole idea for the setup is this previous support is going to hold. So our stop might go in at 95, and our objective could be for a move to here or a move back up to here. But we've got it's a really simple trade setup. Like all these things, it doesn't work all the time, but it's a logical way of looking at markets if we're looking at areas where there's been previous support and resistance, supply and demand. The flip side, of course, if a market rallies up to a previous high and starts to weaken, for those of us who are looking to go short, this is again another obvious level to sell short. We have a defined level of risk. If it breaks through that previous high by a certain amount, whether that's 1 point, 5 point, 10 points, whatever it is for your particular approach, we know what our risk is, we know the reason for the trade based off the previous level. If the market's trending, the approach is maybe slightly different, but the basic fundamentals are still the same. If the market's moving higher, as in this example, we're looking at the previous low, the previous major low. If the market starts to sell off, we're going to see, well, how does the market perform ahead of this old low? So once again, we're looking for the strength to come back in. We're going to place our stop loss somewhere beyond that low and look to get in on the trend. So price action trading, it doesn't have to be complicated, but a really good place to start is looking at previous important levels in the market. Okay, that's the theory, and that's pretty straightforward. I have to say I'm a big fan of price action trading, and to show you why, let's look at a couple of real examples from last week. Let's see how this theory actually bears out in the real world for a couple of popular markets. Let's start off by looking at the euro dollar from Thursday the 13th of July. So coming in to the start of the European session, euro dollar was trading up here around about 114.50, these sort of levels. And you saw it sell off quite sharply by lunchtime, by 12 o'clock, trading down to 113.70. So we saw something like an 80-point sell-off there for the euro dollar. The market bounced back and starts selling off again. And this is where it's getting interesting from us. So this is later on in the day, coming up to 5 o'clock UK time. So we had this old level left from earlier on where clearly stopped a chunk of that decline. The buyers came back in. So let's just mark that up with a horizontal line. So this is the level that really we want to be watching. So these candlesticks, they're 5-minute candles, you can see from up there. Let's just walk through a bit in time to see what we're looking out for. So we are seeing some support coming in. So we've had a 10-minute period now where we have seen buyers coming back in. So the trade here, if we're trading off price action, we might want to be a buyer around about 113.85. We know the previous low from earlier on in the day was 113.70. So we might want to set our stop loss the other side of here, maybe 113.60. So we've got a 25-point stop loss in this example, maybe a little bit more than that. But that's the trade. That's a trade based off the big level, off the price action, and it's a case of waiting to see what happens next. The market wobbles around for a little bit and then starts moving. So we can see it started to move in our favour. And it's just a question of how long we want to hold the trade for. The market's now moved about 20 points in our favour. So some people may be thinking about moving their stop loss up to break even. Other people may be giving it a bit more room to see how the trade pans out. But you see, as we move forward in time, the market does recover off that level, pushes higher, gives back some along the way, and continues to move higher into the next day, into Friday. But there's an example there, from a really popular market about how this stuff doesn't have to be rocket science when it comes to trying to find setups, simple setups to trade based on the price action. Let's look at the same principle, different market, slightly longer term time frame. So what we're looking at here, this is the price of crude oil. Starting off, this is the 11th of July 2017, and we can see the market has had a bit of a move higher from about $43.80 a barrel, starts moving higher, and up here, 11th of July, this is 11 o'clock in the evening, we're trading at around about just below $46. Then if we just jump forward to the 12th of July, the oil inventory numbers come out. They normally come out every Wednesday afternoon, and we can see some volatility in the price of oil. So the market pushed higher, but then sells off. And I think this now has left us with a couple of points near enough the same level to watch for a potential trade in oil. So let's just mark that level up. So we had the dip on the way up, first of all, back here. That was from the 11th of July. Then the market sells off after those oil inventory figures. So let's mark that up as well. And if we were trading off price action, lots of people would have seen the move back here, not taking out that previous low as maybe one opportunity to buy. Let's pretend we missed that, and let's fast forward in time to see what happens next. Okay, so the end of this chart, this is the early hours of Thursday the 13th of July, so about 7 o'clock in the morning. So we've got this band for the price of oil left from $44.90 up to about $45.10. So what we're looking for, if the market starts pushing back into this zone, do we see the buyers come in? If we see the buyers come in, we might want to jump on board with a stop loss the other side of this extreme. This is a 15-minute chart we're looking at, remember? You can see that from up here. So let's just walk forward and see what happens in time. So the market does start pushing lower. So we're pushing down now. And we're probing through that first level of support. So at the moment, we definitely are not seeing any buyers for oil coming in on that, $45.10 level. But let's just jump forward a little bit and see what happens next. We've seen the market push down, test, but not take out this previous low. So far, based on what we have here, and this is around about 9:45, 10 o'clock in the morning, Thursday the 13th of July, there's this old zone that's been left over the last couple of days from $44.90 through to $45.10, where buyers have come in, and so far, although it's only early, we're seeing that happen again. So one approach would be to be a buyer now. We've seen the market hold for the last half an hour, because these are 15-minute candles. We've seen the market hold for the last half an hour above this level. It's currently trading at $45.22, so we may want to be a buyer of oil here and putting our stop loss the other side, maybe down here, $44.75, that sort of area. Let's fast forward and see what happens next. So we'll assume we're in from about $45.20. We're moving forward. Don't forget, each of these is a 15-minute candle. The market comes back again, but our stop loss is here, so we really shouldn't be too bothered. We're just going to let the trade play out and see what happens next. The price of oil just really chops around. So at the moment, we're about 2 hours into the trade. We're down by about 10 cents, and then the market starts to move a lot higher, going back up and almost testing these previous highs. So again, what we would be doing here, if it's a short-term trade, when the market starts to move in our favour a decent amount, think about moving our stop to break even. But if we're expecting a bigger move, we may be happy to leave our stop loss where it is. And then if we just jump forward in time, the market goes sideways for a little bit before starting to move higher ever still. So once again, it's a really simple setup. It doesn't work all the time, but it gives you the low risk but potential high reward trade. So there you have it, a couple of examples where it worked in the real world. And I didn't have to go back weeks and weeks and weeks to find these examples. You see this sort of thing happening all the time. Like everything, it doesn't work all of the time, but it can help line up low risk, potential high reward trades. And I'm a big fan of starting off looking at the price. I think one of the problems in the beginning, particularly I think for new traders, is they think that the key to success is to look at everything. So they end up throwing everything on the chart. So you have moving averages, stochastics, Fibonacci, parabolics, pivot points, all this stuff. So you have so much stuff on the chart, you can't actually see what the price is doing. And they miss that really, the basic bit of what the market is actually doing. So I'm a big supporter of keeping your chart as clean as possible. So that's a quick introduction into one basic aspect of price action trading. We'll expand on this idea over the next few weeks. As usual, if you're not subscribed, if you click the subscribe button there, you'll never miss out when these videos get uploaded. If you like the video, click the thumbs up at the bottom. And if you'd like us to cover anything in the future, you've got any questions, just leave us a comment down below in those messages. And we do read all of these, and that's why we've ended up covering price action today. But for now, we'll wrap things up. So from me, David Jones and Trading 212, we'll do it all again in a week's time. But I hope you have a good trading week.